Did you know that loan pre-approval is not the same as loan pre-qualification? These are actually two very separate things. One thing to distill for you, if you have a pre-approval or a pre-qualification, you can still go see properties. I'm recording this in 2026. NAR guidelines are that agents do need some kind of a letter from a lending institution in order to show you a home. And you can use a pre-approval or a pre-qualification to get in a home, okay? The bank is using both of those to look at you, give you a rough estimate on what you can borrow. But there is a big difference between the two letters. And in a competitive market, if you show up with a pre-approval, it's not as good as showing up with a pre-qualification, but it does still work. It just gets you about 50% of the way there. Before you apply for a pre-approval, there are a few things you're going to need handy, okay? The first is you're going to need your government ID. And if you and let's say your spouse are applying together, you'll need both, okay? So it just times it by two. The second thing that you're going to need is 2 years worth of tax returns. These can be business and they should be personal for sure. But if you do own a business or you've been self-employed, you're going to want to have both. For me, that return is all in one, but for you, it might be several different documents. So be aware that the bank is going to request these. So if you can walk in the door with everything in hand, going to really speed you up. The next thing is you want your last 2 years of your W-2 income. So if you have 1099s or anything from your employer, revenue really wags the dog here. Okay. Whatever you're making is going to dictate how much you can borrow from the bank. The other thing is 2 to 3 months worth of bank statements. I do want to say if you work with your current lender, they're going to have this already. So if you bank at ABC Bank, they aren't going to ask you for bank statements. They can see that and they're very well aware of your payment history. They probably already know your credit score. So what I'm talking about here is very general and I'm really mainly speaking to lenders that don't know you and have never met you before. You also want to have your current mortgage statement. They want to not only make sure that you're caught up on payments, they want to know what that payment amount is, what the APR is, what are the terms. Same thing for your lease, okay? That's something that you pay every month. It's typically a big bill. They're going to want to see that. If you're renting right now and you're buying a place to live in, obviously they're going to understand that that lease payment is going to go away. So don't worry about that, but just come in with the numbers, okay? These lenders, they need to really understand who you are and what you're doing. And the more comfortable they are with you, the more likely they are to lend to you. The next thing you want to do is list out any debts that you have. If you have a car payment, if you have student loans, if you have another mortgage or even a furniture account, it can be anything, but just plan ahead, bring that. I have talked to people that try to hide things and it makes you look really bad if they find out that you have other payments that you didn't disclose. Be aware they're going to see those payments on your bank statement. So if you have, let's say, a furniture payment coming out, or I don't even know, your wages have been garnered, they're going to be able to see that. So don't even bother trying to hide it. I really recommend that you be as honest as you can with any lender that you speak to. There's really no harm here in asking for a pre-qualification. They're not going to bite you or yell at you or anything like that. They're going to do their best. Like most lenders want to lend to you because that's how they make money. But the easier that you make their job, the easier they're going to make your job. So just be aware of that. Some of the things that the lenders are really looking for is that they're going to be looking at your credit score, number one. Okay. So you can go ahead and pull that before you go into a bank. It's actually free through the 3 credit agencies. So you can find that information on your own and kind of have a clue. If that credit score is low, and I'm going to say under 550, be aware that you might want to make that a little bit better before you apply for a loan, but I'm going to leave that up to you. The other thing with regards to credit score is that if you have someone going on the loan with you, and let's say you have a very low credit score, but they have a very high credit score, the lender is most likely going to average that out. And that person with the high credit score, the fact that they're going on the loan with you and they're going to co-sign, that actually goes a long way with the lender. So keep in mind, that is a great hack that if you're having an issue, bringing in a co-signer can really solve issue for you. We do that all the time with tenants. Sometimes we'll have a teenager and they just don't really have a credit score. It doesn't mean that they're a bad borrower. They just have never used credit because they're just starting in college. We'll have their mother or father co-sign the lease for them. And a lender works the same way. As long as there's someone else with skin in the game that has income, they're going to be okay with it. So be aware that there's always a way. And unless you walk in the door and tell them what you have going on in your life, they really can't help you. So don't assume that you're going to fail. Really assume that you're going to win. And I think watching this video will have you very well prepared for that. Other than credit score, the other thing that a lender is looking for is what we call a DTI, debt to income ratio. Okay, this is important. They want to make sure if you're making $3,000 a month, they want to make sure that you're not spending $2,999 a month. If that's the case, you really don't have a whole lot of bandwidth to take out a loan. But if you're making $3,000 a month and your expenses are only $1,000 a month, you look really great to that lender. Okay, so that DTI is really going to come into play. And that's where understanding who you are, what you're doing, and what payments you have versus your income. They're going to look at that. Speaking of income, if you do make extra income on the side, let's say you drive for Uber or you work overtime, bring those receipts. Show the bank where your revenue is coming from. They will count overtime in as wages. Okay, I've had that question a lot where they say, hey, my regular job only pays me $20 an hour. When I work overtime, I make $35 an hour. Well, the lender is going to take that into account and go, wow, Mr. Jerry works really hard. We see his revenue and he's more likely to continue that. Okay. So again, being honest and show them your positives there. Like that's huge. If you have an extra income source, bring that to the table. They love to see that. They're also looking for your employment or income stability. If you've been at your job 2 years or more, you look really good to a lender. They want to see that you're stable. Okay. And if you have a job here and then you're over there and you're kind of switching every few months, that's actually a big negative for a lender. Unfortunately, they want to see that you're stable. You've lived in the same place for a long time. That can help as well. It's that jumping around that really does scare them. Now, if you have a great reason for this, let's say you're the spouse of a military member. Okay. Military members do get moved every 2 years. Lenders understand that. They really do. You're most likely going to be using a VA product anyway, and that shouldn't matter. But if you do have a, extraordinary circumstance, or let's say you've only been at your job for a year, but you were at your other job for 5 years, tell them that. Like, just be honest with them. Right now, I work for company A. I got a promotion. I was at company B for 10 years and I loved it, but now I'm at company A. Things like this, just communication can really go a long way with the lender. The other thing you want to discuss are your assets and reserves. So if you have other assets, let's say you have 3 cars that are paid off, or, a lot of equipment, or maybe you have several homes, that's going to go a long way with the bank. The fact that you have other assets is a really big deal. If you have investment properties like myself, I have multiple investment properties, and they look at that and they say, okay, she has other assets. She is paying the bill. Maybe some of them might be paid off. That's a win for the lender. They see that you have revenue from your investment property helping out with your W-2 income. They're going to count that. They really do like to see that. So definitely put your first foot forward. So the property type really matters as well. If you're even thinking about purchasing multifamily and you're going to live in one unit and rent out the others, tell the bank that information, because they're actually going to probably give you several numbers. I've seen this many times with clients where they'll say, if you purchase a single family home, we will approve you up to $300,000. But if you purchase a 2-family home like a duplex, we'll approve you up to $450,000. Now, why is that? It's because typically they understand that that second unit is going to bring in revenue, and you tell them, I'm going to rent out unit number 2. They're going to go in and calculate that once you go under contract and just make sure that you can still afford it. But they will give you a sheet saying, Mr. Smith is approved up to this amount for a multifamily and this amount for a single family. So be clear with the bank what you're trying to buy. And honestly, if you want several different letters, they'll usually do that. I've had many clients that get pre-approved up to, let's say, $1 million. Very common, but they don't always want to show the seller that they're approved up to $1 million because they're trying to offer less. You can say, okay, Mr. Bank, I'm approved up to $1 million, but I would like 3 letters. Okay, I want one letter that says I'm approved up to $600,000 and one letter that says $850, and then the third letter, let's make it $1 million. And that there's nothing wrong with that. It's not illegal at all. And when you start to look at properties, you can just send the real estate agent the letter that you feel is the most appropriate. Now, if you have a letter for $850 and the property is for sale for $850, I do recommend that you use the letter that says $1 million, because usually if the listing agent thinks that you're buying at the very top of your capabilities, they're going to worry if you would qualify for that property. So you do want to have some, money left there in your letter. You don't want it to be right at the amount. It just kind of looks bad. But definitely get a couple of letters if you're more comfortable. I've done that myself where I just really don't want to show, who I am and that I do have capabilities for more. I want them to think that's all I can afford. And so I do keep my letter within $50,000 to $100,000 of the sales price. One other thing to keep in mind is that banks are also going to look at your reserves. And by reserves, I mean cash. Now, lenders are also considering Bitcoin and other digital assets now as well, but they do want to see that you have expendable cash. You can also show investment accounts. So if you show them your Schwab account or any of those other Goldman Sachs account. Now, the money might be in stocks and bonds, but you could liquidate that. And that does count. I don't want to say as cash, but it does count as liquid, assets. So that's a really nice addition is if you can take your retirement account and say, look, I do have some backup here. That does go a long way with the bank. So what you don't want to do before or during the process, you don't want to open new credit accounts. I've seen it so many times where someone has a house under contract. And that means when you go under contract, that's when the lending process really starts. The worst thing you can do is go buy a car or buy something on credit. That's literally the worst thing you can do. Also, let's say you have $20,000 in cash in your bank account. That's great. You look really good to the lender. If you go spend all of that cash during the lending process and they see that you now have no reserves, there is a chance that you'll get denied for that loan. Or like I said, if you apply for a different loan, like you go buy a car, but you're under contract to buy a house, they're going to immediately rerun that debt to income ratio. They're going to say, oh, well, now that you bought that Mercedes, we're no longer going to loan to you on a house. And I have seen properties, fall out of contract because of this. This is kind of a bonehead mistake. It's a basic thing that every agent should tell you. Once you go under contract, do not spend big chunks of money if you can help it, unless, if you're in business, that's different. I'm speaking only personal, but please don't go get new debts because that can really affect you. One of the other things that you want to avoid is don't make large unexplained deposits. Okay, that's going to look a little bit creepy. If you do this routinely, it's part of your job. I'm going to give you a great example. I'm a property manager. We get very large deposits routinely from Airbnb, VRBO, Appfolio, is dropping money in at the first of the month because we're collecting rent. I'm not speaking about that. That's very historical. I can show where that happens every single month inside my business. That's not an issue. You're under contract and large amounts just magically fall in your checking account and it's not normal. They're going to flag that. I have seen people trying to qualify for a loan and they'll get a friend to lend them a bunch of cash to make them look really good, but it's not actually their cash. And that's actually loan fraud to my understanding. I'm not a lawyer, but you do need to be completely honest. So if they see that you have $50,000 and it's been there for a long time, they go, okay, that's your cash. But if it kind of hits your account and there's really no explanation for it and it happens right around the loan process, they are going to question that and they have every right to. So I do want you to know this is really important. I have seen a few cases where people went to jail and had federal indictments over this. So please avoid anything that even smacks of loan fraud. It's better for you not to even apply for the loan if you can't do it legally and correctly. So please, word to the wise on that. Don't change jobs during the process. Okay, this is huge. If you have a well-paying job and you're trying to buy a house, stay in your well-paying job. And the other thing is I've seen women on maternity leave, they can't close on the house until they return to work. Like the bank goes, okay, the wife, we see that the wife makes great money, but she's on maternity leave. We're not going to lend until she's back at work. They want to know if they're going to give that couple credit for her income, she has to be working. If she's on maternity leave or some other unexpected leave, that's going to freak them out. Okay, so just be aware of how they think. So definitely don't change jobs during the contract process. The other thing is don't co-sign for anyone else. If you, let's say your child buys something and you co-sign on his car, it's going to count against you. So even though it doesn't feel like it's your credit, it really is because you've now co-signed. You've now affected your debt to income because your child's car payment is going to now count against your DTI. So do not co-sign once you're under the process of buying a property. Also, just don't make big purchases. I kind of covered that, but if you're really zeroed in on buying a property, just stay zeroed in. Okay, don't get distracted. You can always buy that after the closing, but you want to make sure that once you start the process and you invest money and time into it, you want to know that you can close. So for investors, this is really important. Investors get a lot of loans. Investors typically use conventional loans. Under conventional loans, they are going to use your DTI. You need to be aware of that. You have to show that you can afford it. Now, one loan that investors do love that doesn't look at DTI is called the DSCR. That is the debt service coverage ratio. In the DSCR loan, a lender is absolutely going to look at you, your income, and your credit score, but they're actually going to weigh more heavily what revenue the property itself will bring in. Okay, so they're going to look at the property's cash flow, not necessarily your cash flow. So if you don't have enough cash flow or write-offs, but they're looking more at the property, it's going to really help. And they're typically looking at a percentage of the revenue towards what the loan is going to be. So let's say they're projecting the property to bring in $1,000 a month, just to keep it very simple. If your loan payment is also $1,000 a month, that's a little bit tight. They typically want to see 1.2% the loan amount, in the payment to loan amount. So if the property is going to bring in $1,200 a month, but the payment is $1,000 a month, they'll most likely approve that. Okay. Now there are all different lenders. Some will go down to 0.8. Some will do it right at 1. It really depends. So talk to your lender, but a DSCR loan is a great product for investors because you are going to have revenue coming in from that loan, and that revenue will be going to make that payment. So just keep that in mind. Your lender choice also matters. So retail lenders aren't typically going to work with investors, but if you're going to go apply for a loan, you do want to be very honest that it's going to be a second home purchase, but you're going to rent it out. For example, if you're buying a short-term rental, or if you're going to buy a multifamily, I'm going to live in it, I'm going to rent out the other 3. A traditional lender can help handle that. That's no problem. But when it's a true investment property, you just want to make sure that the lender that you're talking to, they do investment property loans. Okay, so say that up front. I really don't ever recommend that you lie or mislead anything. Okay, be honest. This will be a rental property. I'm going to run my numbers. As long as they're very confident in you and your knowledge and what you're going to do, you should be fine in this lending process. So I hope this is really helpful. The lending process is so important to real estate investors. And as a real estate agent myself, I always want to know if the person has a pre-approval or a pre-qualification letter, because really the bank is the one setting the budget. You can look at $1 million properties all day if you want to, but if you can't afford to buy it, there's really no need to talk to an agent and go look at a property that's outside your price range. So that's where having this letter in hand really helps. I hope this has been helpful to you. I hope it makes sense, the difference between a pre-approval and a pre-authorization. A pre-approval is much more thorough, and it really says that the bank has taken a really good look at you and you're ready to go. So I wish you all the best in buying a home. If you're looking to buy in the Savannah, Georgia area, I hope you reach out to myself or someone on Team 912. You can simply comment 912 below and we'll reach out to you, or just look us up. We are everywhere. I wish you all the best in your home buying journey. Bye-bye.